Hello and welcome to the channel. In this video we will have a look at one of the best investors method of investing in savings banks and Norwegian banks that have many opportunities for long-term investors who just want to buy good and cheap companies. And you can read here that he has been investing long-term and made a fortune with this method that I will show you in this video. And there are many savings banks in Norway, and that's a special form of entity. And it's a bit more complicated than the regular limited company, but the principle is very, very easy. And follow along here, I will show you how I believe that this famous investor in Norway has bought shares cheaply, and then also filtering out the bad banks, but and focusing on the good banks. And doing this, investing in those good banks in as a group, and just buying the shares when they are trading really cheaply, that has been a really good method. And follow along, I will share with you some examples here, how to see it for yourself, and follow along after if you want to follow the community. I'll share a link with you later here that you can join, and we can find these shares together when they are trading cheaply. Just as a little teaser here, investor Arne Fredli, I believe he has beaten the market for decades, and he has then used the method here of buying these good banks when the shares are way too cheap, and also in these savings banks. So savings banks is a kind of a odd entity that we only have in Norway, I believe. And the main idea is that as shareholders or equity certificate holders, we can only own a portion of the equity of the bank. And that means that there are some different rules, but we still get the dividend. We can still trade certificates freely in the market. And we can even live outside of Norway, like the famous investor here does. He's a Norwegian citizen, but resides outside of Norway, I believe. And then if you are an investor outside of Norway, I think that you are able to buy shares in these savings banks. And there are very many of them, and very little analyzed, I believe. And that gives maybe opportunity for long-term investors who just wait patiently until the shares are trading cheaply, and beforehand just finding out which banks are the good ones, and then measuring that beforehand and just waiting for the shares to be trading too cheaply sometimes. So all of these are not publicly listed, but it's still possible to buy shares in these ones. If you're interested in more deep dives into that, you can follow the channel, and you can read here that we have many savings banks that are publicly listed, so you can find them here in the terminal of Fiscal that I use and recommend here every day. You can try it for free and find these banks by making a screener and searching for Norwegian banks. And I believe we have how many? I'm not sure how many I see in this, but this is just my list, and there are many more, I believe, that Fiscal can get into a list for you here. And the idea is then to go ahead and measure which banks are the most profitable. I would recommend adding a filter here, return on equity. Let's say a 5-year average. And then, I would try then and focus on the banks that have the highest return on equity on average for 5 or 10 years. And wait for those shares to get cheaper. And maybe not investing so much in the bad or worse banks. It's pretty good to have 9% and 8% return on equity, and also if you can get the shares really cheaply. But why not focus on the best ones that also get cheap from time to time? And then, but then if they are the entity of Sparebank, then you should adjust for the real equity that the certificate holders are owning. I can show you an example here, and you can also buy regular banks that have regular entities. You can see it here. If you find one that has there's a abbreviation behind the name, ASA, like the biggest bank of Norway, or Pareto Bank. They are easier to quickly see what the price book is. But let's have a look at, for example, Sparebank 1 Ming, or the ticker is Ming, but it's a bank for you can see here that it's lots of real estate and business loans here. So it's and mostly mortgages for private housing, I believe, but maybe not in this case. But if you have a look at the long-term history of a bank as an example here, you can see that just measuring the share price, it looks quite okay. 8 to 9% annually for 24 years. That's pretty strong, but they pay a regular dividend in addition to the growing share price. In my experience, they typically pay out a generous amount of dividends and retain maybe half or somewhere around that. And you see the long-term return for shareholders, including the dividends. If you look down here in the bottom corner, 16% annually for 24 years. That's amazing, I would say, and just an example that you can have a really, really profitable bank and just own it for the long term, and it might go as well if it continues to be as good to run and operate banks in Norway. But how can you make this even better, like this famous investor Arne Fredli in Norway? Yes, you can look at this bank, one of the most profitable banks measured in in terms of return on equity. And then if you're right about your analysis that this bank is still being very profitable in the future, then you can have a look at the price to book. I will just have a check here if there's tangible book differences. You can have a look here. The main idea is to let them grow organically. That's a bit technical, and you can see later videos about that. But in essence, the book value is mostly just the tangible loan book here. And then simply have a look at the price book. And here we have a 10-year history. And then, of course, here we have to adjust the price book to the equity certificate ratio. But just as assuming that the ratio is much the same, it may not be, but the idea is to buy it at a low price to book per equity certificate, and follow along for a new video about what that is, how you figure out the real price book, and then just monitor these shares and see when they are trading at a very good discount to that real price book ratio. The real price book ratio in this bank in particular is close to 1.5. So that's also not too expensive in my opinion. But that's estimated, or you can look in the annual report of the company, and you see there that the ratio of the equity certificates are roughly 67% or so. So then you just find the calculator and take 1 divided by 0.67, and then you get roughly 1.5, which is the real price book right now. And then we can just monitor the equity every quarter and wait for the share price to drop, and then buy more shares when they are really cheap, and just also monitoring the efficiency of the bank in terms of return on equity. It seems to be growing from over 10 years from 10% to 16%. But in my opinion, if you can have at least 12 or 13% or so return on equity for the long run, it's very good, in my opinion, to buy shares when they are trading below book value, and then if you are right about the return on equity being good in the future also. And Here in Norway, it has been many banks that have been able to have a really high return on equity, much better than the market, and at the same time have very cheap shares. In Sweden, for example, the shares can be much more expensive, 2 or 3 times the book value. And that's very common in the European market and in the American market. But for some reason, maybe not so many people like to invest in these boring banks, and then maybe, well, I don't know why, but they are quite cheap at times. So in my opinion, if I would do a quick analysis here and I would try and buy this share at roughly price book 1, if you look at the annual report here and you see that the ratio here of the equity certificate, maybe I didn't mention it, but equity certificates are only relevant to these forms called sparebank or savings bank. So if the real price book now is around 1.5, we would want to have a 30% reduction in the price, roughly. And since the price is around, let's say, close to 200, 210 or so, a good price would be, in my opinion, then 150 krones or 160 or 140. Then we would, in my opinion, then get an extra good return if the shares and if the company and bank operates well in the future also. My bet is that if you bought the share here November 2022, you would get a very decent return, and the price book was quite low then compared to now. And then if you just measure this in fiscal, like I do here, let's go to November 2022. I believe it's, I went too long here, let's see, 2022 here. So it's amazing, 20% just on the share price growth. And yeah, the price book is on the higher end compared to what is normal in Norway. But if you add the dividends, which are a big part of the returns to the investors, then you are indeed getting 29% annually just by being a long-term investor and just also buying the shares when they are trading cheaply compared to book value. Of course, before you go ahead and buy a bank, in my opinion, I would double check in the quarterly reports of the banks. You can do it here, for example, and it's even in English, so you can check here. And if I can share with you here now, then you can look at the key figures, and you see the return on equity here presented. That's very important. You can compare the banks and see which have the best cost ratios, being more, have low costs, and also have a look at the ECC ratio, equity certificate ratio. And here's how you find out what is the real book value. And you see the bank states every quarter what is the price book measured in this equity certificate. So if that was an interesting idea, please follow for more videos, and I will share a link below in the future that we can join for in a community here on YouTube, and then we can have a look if these bank shares will get traded cheaply again, and use the same method as the best investors in Norway. Just sit patiently and wait, and then get the shares cheaply, and then be a long-term investor holding those shares and receive the dividends every year from these holdings. And if this is interesting, I have lots of other ideas also, so please follow along the channel here and give a thumbs up if this was good content and interesting. And feel free to comment if you want more information about how we go about with finding these kind of companies. Thank you for watching until the end, and I hope to see you in the next one.